Hi candidate, welcome to another session of manifested online classes. So in this session, I want us to look on some illustrations regarding the computation of goodwill arising from business combination or arising from acquisition. Remember in our previous session, we defined what is goodwill, and also we looked on the two methods which are used in the computation of goodwill arising from business combination. The first method was the full goodwill method, whereby we said the goodwill computed is attributable to both the parent entity and also NCI. We also looked on method number 2, which is called the partial goodwill method. And under that particular method, we said that the goodwill determined is attributable to the parent entity only. So in this particular session, I want us to look on an illustration regarding the computation of the same. And we go through that particular illustration. It reads, on 30th of April 2024, H Limited acquired 80% of 5 million ordinary shares of shillings 10 each in S Limited, paying shillings 100 million cash. On that date, the fair value of S Limited net asset was shillings 75 million, and the fair value of the company's ordinary shares was shillings 20 each. So what are we required to do? Part A, calculate the goodwill arising on acquisition using Roman 1, partial goodwill method, Roman 2, full goodwill method, and then in part B of that question we are told, assume that the goodwill determined in Roman 2 above, that is the goodwill determined using the full goodwill method, was impaired by 9 million as at the end of the year. Show the allocation of the impairment loss to the parent and also the non-controlling interest goodwill. So this is basically an illustration whereby we are required to compute now the goodwill. And anytime you come across a question for group accounts, the first thing you need to do as a candidate is to come up with a group structure. So basically a group structure is a form of a chart whereby you'll be having now the parent company, shareholding in what? In the subsidiary, and also in your group structure, you must incorporate something called the date of acquisition. That is the first thing we need to do here. Remember, this is an illustration regarding computation of goodwill. So the first thing we need to do here is to come up with the group structure. I've said that this is a chart which shows the parent company shareholding in what? In the subsidiary. So in this case, we're told on 30th of April 2024, the company which is called H Limited acquired 80% of the 5 million ordinary shares of shillings 10 each issued by the company which is called S Limited. And this acquisition took place on 30th of April 2024. So basically what that means is that from this group structure, then H Limited here will be the parent company, whereas S Limited will be the subsidiary. Remember what you have said is that IFRS 3, International Financial Reporting Standard number 3, requires that the parent company on the date of acquisition should determine the goodwill arising from the business what? A combination. And actually we have said that that goodwill arising from business combination is always determined on this particular date of acquisition, and it can be determined using either the full goodwill method or the partial goodwill method. So what we are required in part A of that particular question is we calculate, or basically we compute the goodwill arising on the acquisition, and Roman 1, we are required to use the partial goodwill method. We are required to use the partial goodwill method. So under the partial goodwill method, here we have said that we compute the goodwill attributable to the parent entity only. And basically to do this, to compute this, we need to have two columns here, and also the figures which we are given there are in million of shillings, million of shillings. So always we start with the purchase consideration paid by the parent, purchase consideration by the parent company. And if we go back to the information which you're given, actually in sentence number 1, you're told on 30th of April 2024, H Limited, which is the parent, acquired 80% of 5 million ordinary shares of shillings 10 each in S Limited, paying shillings 100 million cash. So the amount which was paid by the parent company was 100 million. And then now to this, what do? We less the fair value of net assets acquired by the parent, net assets acquired by the parent company or by the parent entity. So remember what we have said in our previous session is that in most of the cases, the examiner will not give you the net assets of the subsidiary company on the date of acquisition. And actually, you have said that if that figure is not provided to you, that is how you compute it. You take the subsidiary company ordinary share capital plus all pre-acquisition reserves of the subsidiary. But if you check on the information given in this particular question, in sentence number 2, we are told on that date, that is on the date of acquisition, the fair value of S Limited net assets was 75 million. So therefore, we are given the fair value of the subsidiary company net asset on the date of acquisition, which we are told they had a value of 75 million. But in our case here, what we are interested with, we're interested with the net asset which were acquired by the parent. So in this case, our parent company, that is H Limited, acquired 80% of the shares in the subsidiary, and that also means that our parent company, that is H Limited, acquired 80% of the net asset of S. So therefore, the net asset which were acquired will be 80% of this. And 80% of 75, that will give us 60 million. So we less that from the cost of investment or the purchase consideration. So we get a positive figure here, which is a goodwill. So remember what you have said is that this particular goodwill, this one is recognized as a non-current asset in the consolidated statement of financial position. So that's how we determine the goodwill using the partial goodwill method. So Roman 2, we are required to determine this particular goodwill arising on acquisition using the full goodwill method. Using the full goodwill method. Recall we say that under this particular method here, we determine the goodwill attributable to both the parent entity and also what? And also the NCI. So we need to have two columns here. Figures are also in million of shillings. So under the full goodwill method, number 1, we start by taking into account purchase consideration paid by parent entity or parent company, which we already have here, 100 million. And then to this, we add the NCI at fair value. So NCI at fair value, I've said in very simple terms, this is the purchase consideration which was paid by the minority shareholders in acquiring their shares. Like in this case, you can see 80% of the shares issued by this subsidiary are held by the parent. What that means is that the remaining 20% of the shares, issued by S, these shares are held by minority shareholders, and we have referred to the interest of the minority shareholders as what? The non-controlling interest. So when the minority shareholders were acquiring 20% of the shares, how much amount did they paid? And that is what we refer as the NCI at fair value. Basically, I've said that in most of the cases, this figure will be given, or the examiner will give you this particular figure. But if you're not given that figure, for example, in this particular question here, we are not given the NCI at fair value. So if you are not given the NCI at fair value, I've said, the first thing we need to do is to determine how many shares are held by the minority shareholders in the subsidiary, and then multiply that with the fair value per share. For example, in this case, as per the first sentence, we know that the shares issued by S Limited were 5 million. The shares issued by S Limited were 5 million. So these are the shares issued by S. So what are we interested with? Shares held by NCI, shares acquired by minority shareholders, which will be 20%. So this will give us the shares acquired by the NCI. And then what we need to do is to multiply those particular shares with their market value or with their fair value on the date of acquisition. And actually, if you go back to the information which are given in that illustration, in sentence number 2, we are told on that date, that is on the date of acquisition, the fair value of S Limited net asset was 75 million and the fair value of the company's ordinary shares was 20 shillings. So basically, it means that on the date of acquisition, the shares of this company were trading at a price of 20. They had a market price of 20. So we multiply that with 20 shillings per share, and basically this give us what? This give us now the NCI at fair value, and basically 20% of that will give us 1 million. 1 million times times what? 20, which will give us 20 million. So we add these two figures, which will give us 120, and then now to this, what do we do? To this we less the fair value of net assets, fair value of net assets acquired. In this case, we are interested with the net asset acquired by both the parent company and NCI. So how do we compute this? So remember, in our case, we were told that on the date of acquisition, the fair value of subsidiary company net asset was 75 million. That figure is already given to us. So in our case, what we are interested with are the net asset acquired by the parent, net asset acquired by who? The NCI. And automatically, that should be 100%. That should be 100 what? Percent. So we get 100% of that, which will give us 75 million. So we less it from the figure which we have up there. This will give us 5, and then 11 minus 7, which will give us what? Which will give us 45. So this 45 million, this one we refer to it as the full goodwill. So the reason why you refer to it as the full goodwill is because this is the goodwill attributable to the parent company and also attributable to NCI. Remember, this particular goodwill here, which we have determined under the partial goodwill method, we have said that this is a goodwill attributable to the parent entity only, or to the parent company only. But this is the goodwill attributable to both the parent company and also the non-controlling interest. So that is it. That's what was required in part A of that particular question. You determine the goodwill arising from acquisition using the partial and also the full goodwill method. And then part B of that particular question, it reads, assumes that the goodwill determined in Roman 2, that is the goodwill determined using the full goodwill method here, was impaired by 9 million at the end of the year. So what you're required to do is to show how that impairment loss will be allocated to the parent and also the NCI goodwill. So what you're required to do in part B is to allocate the impairment loss. So first of all, we have to recall that impairment loss, this is the decrease in the value of a goodwill. So anytime the value of goodwill reduces, because goodwill is an asset, so that reduction in the value of the goodwill is an impairment loss. Now, what you are told is that we assume that this particular goodwill here, determined using the full goodwill method, was impaired with 9 million. So the impairment loss is equal to 9 million. So how do we allocate this particular impairment loss to both the parent and also NCI goodwill? So the amount now, or the amount of impairment loss, which will be allocated to parent company goodwill, this is equal to the full amount of impairment loss, which is 9 million, times the parent company shareholding in the subsidiary. So recall that the parent company shareholding in the subsidiary is what? 80%. So we get 80% of this, which will give us 7.2 million. That is the amount of impairment loss to be allocated to the parent company goodwill. And then we also show the amount of impairment loss to be allocated to the NCI goodwill. To the NCI goodwill, which will be equal to the full amount of impairment loss, 9 million, times the percentage NCI. Percentage NCI here we are talking of 20%. 20%. So this will give us what? This will give us 1.8 million. 1.8 million. So therefore, this basically how we compute the goodwill using both the partial goodwill method and also the full goodwill method. In case there is any impairment loss, which is basically a reduction in the value of goodwill, we have said that that particular impairment loss, number one, it reduces the value of the goodwill. For example, now this particular goodwill, because we are told it was impaired by 9 million, this will be reduced with how much? It will be reduced with 9 million. With the 9 million, meaning that at the end of the year, when the parent company is preparing the consolidated statement of financial position, the goodwill will be recorded there at a value of that is 6 million. And then also you have to recall what we said in our previous session, that this particular amount of impairment loss, 9 million, this one is supposed to be recognized as administrative expense in the consolidated statement of profit or loss. In the consolidated statement of profit or of what? In the consolidated statement of profit or loss. So basically that is it. That what was required in that particular illustration. So see you in the next session as we look on another concept of group accounts.